With all the trading indicators that are available and their ease of use, not usually successful though, it's easy to forget that simple still works. Now, let's not confuse simple with being easy though, but in this instance, I want to use simple in terms of price action and structure. I also don't want to take away from the simple nature of trading indicators, but understand that price is needed to make them work. So why not just go to the source? Now, it's not that I'm against all trading indicators because I do find usefulness in a few of them, just not to dictate my trades. Interesting enough, though, whenever you look at a trading forum and someone posts a chart with a moving average, for example, the common question is, well, what's that setting? So does it really matter if the setting is 20 or 30 periods? Of course, over many trades, the answer is probably not. Now, while the NetPicks trading systems utilize indicators, you do not trade them blindly. Discretion is taught during your training, which enables you to expertly pick the higher probability trading plays that are shown directly on your trading chart. But this is not about trading indicators. This is about structure, price, and simply trading basics that are used with some skill. Now, the following charts are from a recent trading session, and as you can see, no indicators were used for the trading choices. I'm going to break down what I find to be the most important details on these charts. Now, some may agree, some may disagree, but it works for me, and to me, that's all that really matters. The pattern of the uptrend is broken for a swing once a lower high is put in place. The uptrend line actually originates further off to the left of this chart, but you can see that the higher low after the lower high comes into the line, although a zone around the line is close enough. A high is put in, and the price pulls back again in the location of the uptrend line. The line does not actually physically hold price, but trend lines are more or less measures about the current state and volatility of the market. There's a rhythm to price movements. A lower high is put in again just before the open. The horizontal line originates from the left where price was supporting in that zone, and it eventually broke through it. Price is now up into the same line and appears to be showing that sellers are willing to resist at this price. Now note, there is much subjectivity around support and resistance lines, so I just use areas that are obvious. If I have to search for an area, I'm not really interested in it. At the open, price slams through the trend line, has a stall around the higher low just off to the left, and then falls to a more prominent pivot area. Again, note, pivot area is not to be confused with pivot points. Pivot areas are simply areas where price turned. There are major and there are minor pivot areas. Now, whenever I see a strong move in one direction, especially after the break of a technical such as trend lines, I get very interested. This next trading chart shows the strong move down, and then something interesting happens at the pivot marked A. Price breaches the low, and it's quickly bought up. It's a failure test of the support zone, and given that oftentimes a trend line broke into any side gets a revisit of price, as you can see in B, I bought into the move once price confirmed the direction through a break of the high of the failure test candle. Now note, this trade actually does get stopped out for scratch, but it's bought back again and the target is reached. Now, price has done what I expected it to do after it showed a failure to break the pivot. It's sitting up inside the trend line, and the high of the candle is running into a trend line off the highs of the previous two candles marked A. Now, not shown on this chart, but you can also form a channel using the downward trend line, and you would see price break through the low and then retest just like we see on the bigger trend line. Price is also being held up at a price zone that is providing resistance to the bulls. Now, you can see in the inset box that as soon as bear stepped in, a short trading position was taken. Now, these are simple concepts. However, they can be difficult to implement due to subjectivity that virtually all of us have. Trading indicators are popular for many people because if you just follow the indicator, your emotions, your judgments, and some biases can be removed. Although blindly following an indicator, in my opinion, it's just a recipe for disaster. So let's see if we can make some of what's been covered objective. Number one, we can just draw trend lines from the last 2 or 3 lows or highs. Number two, we can use pivots only when highs, lows are taken out to confirm the pivot. And 3, failure test must conclude with the testing candle closing 50% or more up or down the body. Now, I'm sure there are a few more variables that we can put rules around, but this is a really good starting point. And as I mentioned earlier, I don't dismiss all trading indicators, as there are some that are pretty useful. Yes, even the moving average set at the basic setting of 20 can be used to help you frame the market. Now, this entire piece was to show that indicators are not a necessity, and you can learn to skillfully trade using just what you see on the chart. It's a skill that can be learned, but give yourself time to become proficient. Trading can be lucrative, and it's really naive to think that a PDF and a week of studying will have you raking in the money the following week. So be a professional in your trading and on the journey towards your success.